Welcome back to our channel. So last week, a uranium junior we cover released a preliminary economic assessment. In this video, I have two objectives. Number one, I want to show you why we think the stock is extremely undervalued. And number two, I want to show you how we analyze economic studies published by resource companies. The company we are talking about today is Blue Sky Uranium. Shares of this company are trading on the TSXV Venture Exchange. Its market cap is about $18 million, so it's a tiny micro cap stock. Now, the company has an advanced stage uranium project in Argentina. Argentina is an excellent market for uranium producers or explorers, and that's because Argentina has no domestic production. 100% of its consumption are imported, and Argentina needs uranium because it has 3 operating nuclear reactors, and there are 3 more in planning or construction stages. With that, let's take a look at Blue Sky's latest PEA. Now, a PEA is an independent study conducted to analyze the economic viability of a project. In the company's press release, they provide a lot of details and numbers. The table here shows what we feel are the most important factors that we need to look at in the PEA. Let's look at each factor one by one. Now, the first thing to look for is whether the project can be an open pit or underground operation. Now, the Blue Skies project has a shallow deposit, which means that the project can be mined through open pit operations, and open pit operations are relatively cheaper than underground operations. Number two, let's take a look at grades. The average grade of this deposit is 0.038%, which is very low. How do we know this? A quick Google search will let you know that the average global grade for uranium deposits is about 0.1%, and high grade deposits have grades of 20% and higher. So 0.038% for this company is a very low grade. Now, low grades generally mean higher cost of operation, but the fact that Blue Sky's deposit is shallow, open pitable, we feel that the negative impact of lower grades is offset by the fact that it's open pitable. Next we look at is the strip ratio. In this case it's 1.5. What it means is that 1.5 tons of waste materials have to be removed before being able to access mineralized materials. 1.5 is a low number because most of the mining operations out there have strip ratios of 2 or higher. In some cases, it's even higher than 6 times. Number 4, potential annual production. In this case, this project can potentially produce 1.5 million pounds of uranium per year. To put things in perspective, the global annual uranium production is about 120 million pounds. So this means that this project can potentially produce or account for 1% of global uranium production. Number 5, and the last key metric, the mine life. This project has potential to be in operations for 11 years, making it a medium-sized deposit. Overall, our key takeaways are this project has a shallow deposit, open pitable, low grades, low strip ratio, and they can account for approximately 1% of global production for the next 10 years. With that, let's take a look at the project's economics. The study used $75 a pound, which is in line with our long-term average forecast. The current spot price is over $100 a pound, so we feel the study is relatively conservative. The first thing I look for is cash cost. In this case, it's just $23 a pound. That implies a margin of over $75 a pound at current spot prices and over $50 a pound at our long-term average price of $75. My second key important metric is the project's CAPEX. Now, this project needs about $160 million investment to be advanced to production. That is relatively low for mining projects, given that large uranium projects need billions of dollars of investments to be advanced to production. Number 3, and the project's most important set of metrics, is the NPV, net present value, or IRR. In this case, the study returned an after-tax NPV of $228 million US and an IRR of 39%. This IRR is very high, given that most mining projects have IRRs ranging between 15 and 25%. We also checked out the project's sensitivity table and found that NPV and IRR estimates are attractive even if uranium prices are lowered. In the final part of our analysis, we compared the project's NPV to Blue Sky's market cap and enterprise value. Now, Blue Sky's market cap is $13 million, enterprise value is $12 million, and NPV, as I mentioned earlier, is $228 million, which means both market cap and enterprise value are trading at 5% of the project's NPV. Now, what that means is that the market is significantly undervaluing the project and offering it just 5% of the real value of the project. That's what I have for you today. If you like our content, please support us, subscribe to our channel, like and share. Thanks for watching, and I'll be back with you next week with more ideas.